Welcome to Revision 3 for Accounting, Financial Statements, Level 2. Just wanted to first of all a shout out for those who've got some comments based on the previous one. Thank you for your comments, and particularly those people that have been doing the Kahoots. It's really impressive to see how much better you are in the second go than the first go. So keep doing those Kahoots. There's another one today, so I hope you enjoy that one. Today I thought I'd start off with some revision questions, and the revision questions from our last two. So if you make sure you're ready, make sure you've got your book that you can write some notes in. You'll need that today, and we'll move on to notes really for today. Today's session's around balance day adjustments. We're looking at the first 6 out of the 12 that you need to do, and really today's about recognition of those balance day adjustments. They're key if you want to get excellence and merit marks. Even just to pass is pretty key to have these ones. So just a revision to start off with. Firstly, we're going to look at the service and trading income statements, the differences between them. So just some questions for you. Shout out the answer, because the only one who'll hear you is anyone in your room. So the first one is before the income in the income statement for trading and service businesses, what's the difference between a trading and service company in the income statement? Shout out the answer. The answer, trading has cost of goods sold and gross profit, whereas the other one, service business, just has income and other income. Alright, so press pause after the question perhaps, see if you can work it out, and the answer will come immediately after. Group 1 costs, so after other income, other expenses, we've got Group 1 costs, then we've got administrative expenses, and then we've got financial cost. So I'm after the name of that Group 1 cost. So the first one for you is a trading business. What's the Group 1 cost for a trading business? Press pause, shout it out, and check your answer. Did you get that? Alright, so distribution cost for a trading business. It's different for service-based businesses. Remember, Group 1 costs are those that interact with a customer, things like advertising and those that are involved with getting the goods or the service to the customer. Try a photographer. What's the cost for a photographer? It's not distribution cost, it is. Shout it out, press pause, and check. Alright, try a plumber. Group 1 is what? Good. Try an accountant. Group 1 is called what? Press pause, shout it out, check. And a courier. What will Group 1 be called for a courier? Press pause, shout it out, and check. Good. So I hope you got all those right. So easy to classify. Make sure that in there are only your costs. A question came, the difference between costs and assets. Costs or expenses, there's nothing left at the end, whereas assets, you've actually got something that has value at the end. Alright, so today we're going to look at the balance day adjustments. In your notes, get your 1B5 out, and I'd like you to head up balance day adjustments, key terms and rules. And so we're going to copy this one down. Balance day adjustments, key terms and rules. So the first one you're going to write in is, the first rule is if it has the word accrued in it, accrued means owing but without GST. So that's going to be accrued expenses and accrued income. So GST is ignored. The easy part is that there are only 4 things it could possibly be. For accrued expenses, it can only be accrued income, accrued wages or interest owing to us, because our expenses that don't have GST. And for accrued income, things owed to us without GST is again income from interest, like term deposit, and the dividends, because neither of those have GST. So if it's got interest, it's going to be accrued. Dividends and wages, salaries are the other 2. Second rule, I want you to write this down too. If it has the word accounts, accounts means owing with GST. So that's accounts receivable, owing to us, with the GST owing to us as well. And accounts payable, where we've got an invoice we owe to somebody else, and we owe them for what we bought off them, plus we owe them for GST. So accounts, there has to be a GST component. So write that in. Also number 3, write that in. GST is always the opposite side of accounts. So if we debit accounts receivable, we're going to credit GST. If we debit accounts payable, we're going to credit GST. So GST is always the opposite side when we incur that cost. Same with bad debts. With bad debts, we've got we're going to credit accounts receivable, so the debit will be GST. So GST is always on the opposite side of the word accounts. Number 4, write that in. If it's in advance, so prepayments or income in advance, GST's got to be taken right out of the excuse me, situation. What that means is that we pay the GST when we do the prepayment, and we claim it back from the government then. Same with the income in advance. When we receive it, we'll have to have that liability then. So if it's in advance, the balance to adjustment, get rid of GST. The other rule 5, if in advance, both happens on the changes happen on the same side of the trial balance. So write that in. And number 6, really important, the debit side always equals the credit side. That Kahoot challenge is for a bit later. So hopefully you got all that written in. Press pause, write them in. Right, the next step, this table here I'd like you to write up. I'll just increase the size here. And so these are the different adjustments we're going to have. So start writing those in. Press pause once you've got them all in. So these are the 6 we're looking at. Right, we're going to go through each one. So we're going to firstly put the name of it. So the expense owing without GST. Without GST, the word we're after is accrued. Oh. And because it's an expense, it's accrued expenses. So write that in. Expense owing with GST, so that's accounts. So accounts payable, we're going to have to pay that. Normally that's an invoice we give them. Income owing without GST, so that's again going to be accrued. Write that one in. Income owing with GST, so that's going to be accounts. And because it's income, it's owing to us. So that's accounts receivable. Expense paid in advance, see if you can remember. Shout it out. Hopefully you got prepayments. Income in advance. Shout it out. Income in advance, good. So we'll go through each one. Note all of them are current because we have to pay them back or get the money within the next accounting period. So that means current. So first one is a current liability. You're going to have to pay it soon. So accrued expenses is a current liability, and we'll write in an example. So wages owing. So either wages owing or interest owing. They're the two that it can be. Notice that it doesn't have with GST there. And the impact, we write that in as well, is that you're going to add that to wages on the debit side, and you're going to add that to accrued expenses on the credit side because it's a liability. Debit sides are expenses, credit side's liability, so we've got something on both sides. Expense owing with GST is called accounts payable because it's got the GST on it. Because it's expense owing, it's current liability. It might not be an expense either, it might be an asset that we have to pay for. So if we've received an invoice with GST, it becomes accounts payable. And the example I've got is invoice received for electricity, including GST. So that's what it'll look like. The invoice might not be for electricity. It could be for one of many things. It could be for advertising. It could be for the payment of property, plant and equipment. So the only thing that will change will be the electricity there. The impact of that, because it's owing means add on. Probably should have put that in the rule. So we're going to add on to electricity, and accounts payable we're going to add on because we owe more money to people. The GST is going to be a minus because we can claim that back off the government. So we're going to debit GST. Good. Income owing without GST is called accrued income. So accrued income, it's owing to us. So it's going to be an asset, current asset. an example, dividends owing. So either dividends owing or term deposit interest owing. With a term deposit, often they make you calculate that. Dividends, often we just get the figure. Accrued income is going to be the debit part. So on the debit side, we're adding an asset called accrued income down the bottom of your trial balance. In your dividends received or your interest received, there'll already be a figure, so you'll just have to add it onto that one. Income owing with GST is called accounts receivable, so that's going to be, for us, a current asset. And an example, invoice sent to customers, so we are sending invoice to customers, and that includes GST. Accounts payable is going to be the debit because it's an asset. And what goes on the opposite side of accounts? Good, we'll make that our next one. We'll owe more money to the government, so we're adding it to a GST liability. And then in this case, if it's for a trading business, it'll be sales. If it's a service business, it's fees. It'll add on to the income that we've earned. Alright, next one, prepayments, is a current good asset. And our an example for that, best example for that normally is insurance, because we pay that at the beginning of the year and it goes right through. So what we have paid for but haven't used up is a current asset. And again, you might have to calculate that based on the amount of the year that we've been through. And the rule around this is they both happen on the same side. So we're going to go debit to prepayments on the debit side. The insurance is a credit. It says credit here, but it just means taking it away on the debit side. And last one, income in advance, is a current good liability. Got that one. And an example. Rent's often a good one because we make our tenants pay in advance before they have their time in the house. And so this one here is a little bit different. Instead of both being on the debit side, they're both going to be on the credit side. So can you guess? Income in advance is a liability, so that's going to be the credit entry. And revenue, is that going to increase or decrease our revenue? If we've received money in advance, does that count for income of this year or next year? Great, so it's next year. So because it's next year, not this year, we have to take it off this year's earnings. Brilliant. So that's the end of the video. What are your tasks now to do is just a simple Kahoot. There are 10 questions. I'll send you the link with this video. And it's just a recognition one. So a nice short one today. And again, you'll be through this whole session in the 20 minutes that I've set for it. In our next session, we're going to look at either the other 6 balance day adjustments, or we might do a little bit more work on these 6. Good luck, thanks for doing this, and I look forward to seeing your Kahoot results come through. Ka kite, see you next time.